Welcome to today's episode of Startup with Poland, where we continue our deep dive into Poland's startup ecosystem and speak with some of its key players. My name is Tessa McIver and I am your host. My guest today is Paweł Maj, who's a partner at Warsaw Equity Group. WEG is a leading private investment company based in the CEE region with a 20-year history. And Pavo himself has completed more than 60 investments, over 20 exits, and has served on the supervisory body of over 30 companies. Today, Pavo will help us crunch some of the most recent numbers ascertaining venture capital investments in Poland and CEE, and give a comparison to global trends. And we'll discover what story is actually unfolding behind the numbers. So Pavo, wonderful to have you with us here today.
Thank you very much for the invite, and great to be here.
Wonderful. So Pavo, first question. Between 2021 and 2022, we saw a real sort of hyperactivity in the VC space, but that bubble seems to have burst. And why is that? And what are your predictions for the future?
Well, first of all, I would say that maybe the bubble did not burst, but we are coming back to the normal before the pandemic levels.
Okay.
Look at the number of transactions, value of the VC transactions into the VC ecosystem, startup ecosystem. We see around the world, but also here in the Central and Eastern Europe and in Poland, that actually we are coming back to the activity that we have seen before the pandemic. What caused this hyperactivity, as you called it? In the States, first of all, it was the Fed, which pumped almost $6 trillion by buying treasury and corporate bonds. So this money went back to the money had to find a source where to be invested. So the stock market, the VC market, private equity markets, we also, in all these areas, we have seen the increase of the activity. The second reason was the ultra low interest rates. So also the investors were looking for other sources of the income, since the bonds were providing very low return on the invested capital. Thirdly, the pandemic caused actually this great expectations regarding the new technologies that actually high interest in the tools for communication, the tools for e-commerce, that this activity actually would go on forever. So the investors were less hesitant to put the money into tech space, especially anything related to virtual beings, the remote work, remote communication, hoping that it's not only a short period trend, but actually that it's like a long-lasting trend that we'll see for the next years and decades to come. The reality proved us wrong. We have seen, of course, there was this hyperactivity during the COVID. There were lockdowns. Customers, corporations were looking for ways of communicating, doing business. But once the economies opened once again and we're able to do business offline, we have seen that customers, that clients actually were eager for face-to-face contacts, to do the shopping in real stores, not only online. Actually, this hyper-evaluations and high expectations, some of them proven to be wrong, actually.
Certainly, I remember, being desperate to actually see humans again and, be able to have a conversation in a shop rather than just doing everything online. So I can understand this. And what about VCs themselves when it comes to fundraising? I mean, what do you think the appetite is currently among limited partners, and what's the situation there?
Well, so first of all, maybe let's start with definitions for limited partners. Maybe not of the audience understands the term. Limited partners are investors who invest in venture capital funds or private equity funds. So actually they provide the capital for the VCs, partners, managers of the VC funds, private equity funds, that they can invest in tech company startups. So as we have seen the hyperactivity among the VCs investing in the startups, we also have seen in the last 2-3 years hyperactivity among LPs investing into VCs. As the valuations increased, as the activity increased, as the money became less and less expensive, the LPs were more eager to invest into VCs. As we see the reverse of this trend, also we see the same among the LPs right now. They are more hesitant to invest. They are more risk aware. So we see, as we have seen, the drop in the VC activity year to year. It's about 50% globally in the amount invested. Over 60% from the peak, which we have seen the fourth quarter 21. We see the similar trends among the LPs. Right now, venture capital funds have much harder time fundraising. Since investors, they see the drop of valuations or drop of the returns, which we see on the public market among tech companies. Just to give you some kind of point of reference, the valuation of the tech companies listed in the US on the NASDAQ, it decreased about by 66% from the peak time in between 2021. So we see the same drop or similar drop in valuations, especially at later rounds on private market at later stage where VC invest. I assume that everyone have heard about the drop in valuation of WeWork, Klarna, the drops between 70 to even 90%. And from the previous round or the top round, and the LPs are also hesitant. So look at the data. The most recent data from the global perspective that we received is from PitchBook of the activity among VCs fundraising globally. VCs in the first quarter of 23 fundraised only $12 billion. Which is about, if this pace will continue, it would mean about 73% drop year to year comparing to 2021, when the VCs were able to fundraise about 150 billion just in the US. So we see a big drop, especially the VCs that invest at later stages. They have bigger problems fundraising than early stage VCs investing at pre-seed or seed levels, since this is where we see the highest drop in valuations and the highest drop in activity. So these trends may be not as big as among the startups, but actually the VC managers and the startups, it's one ecosystem and they are correlated. This is the word I was looking for. So actually we see and we are having the same problems.
Is the situation the same all over the globe? We're talking about sort of global trends, but I mean, how does the CEE region compare? Do we see the same trends, or are we slightly different from what's going on, around the world? And, what also are your predictions that will happen, specifically maybe looking at CEE, in the coming years?
So first of all, at the beginning of last year, when we already have seen the global decreasing of VC activity, we have not seen it back then in the CEE region, including the Baltics or Poland. So some were too quickly to judge that maybe we are very resilient and maybe this downturn will not seen it in the CEE region. We are so unique, our tech advantage, the tech talent that we have, and the fact that we are still underdeveloped. Look at the amount of money invested per capita, for example, that will be like the green island. However, what time has shown us that actually there's a delay, about 6 months delay between the global trends, so the trends coming from the US, reaching the Western Europe and the CEE region. So actually this downturn actually came to the CEE region as well, but it took us about 6 months delay. So there is not a big difference actually. Of course, in the Central and Eastern Europe still it's much more difficult to fundraise large amount of capital for later stages. You need to have traction internationally and globally. You have to go to the global investors. Actually, this is actually, I would say, it's similar to all the regions globally, that when you fundraise at early stage, you are most likely to fundraise among local or regional investors. But once your startup grows and you are looking for a growth round, maybe above $50 or $100 million, then actually the go-to-market is global market. Since there is not a lot of such scale-ups that already have scale and are able to fundraise much larger rounds, actually here you have global investors. So there's not a lot of local investors investing at larger rounds, but it doesn't make sense because it's not a lot of startups that would fit their criteria. So once you grow and go for the next round, it's more likely that you have to go to international global investors who are seeking such startups and such investments.
Yeah. Okay.
So from money perspective, no. Of course, still what we see is that startups from the Central Eastern Europe, they still have discount regarding the valuation. So if you are located in this region, you should expect your valuation being about 30-40% lower than similar startups in Western Europe. Also, you'll be able to fundraise a bit smaller amount at a given stage. Disadvantage, but on the other hand, being here in the Central Eastern Europe, you have the cost advantages that you don't have being, let's say, in the Silicon Valley, where the living costs, the wages are much higher than here. So yes, you will fundraise smaller capital, smaller valuation, but on the other hand, smaller amount of capital may give you longer runway. You will be able to accomplish more that similar startup in the States, for example.
So we have some element of a green island from that perspective. But indeed, if we're talking about, growth stage startups or even, unicorn hunting, what, in your opinion, are the industries and sectors that we should really be keeping our eyes on? What's hot, not only now, because we know what's currently sort of, people are talking about most, but what in the coming months or coming years, if we can do a crystal ball that far, would you predict what we should be keeping our eyes open for?
Maybe I'm not the best person to ask this question, especially that I'm a partner in Warsaw Equity Group, and we say publicly that we are not in business of unicorn hunting. So we are looking for great companies, startups, technologies to invest in, but in our criteria, investing in a future unicorn, it's not the criteria that we look for. We just look for great businesses. And if this great business will not reach unicorn status, but will bring us great return on invested capital, it's great, actually. So this is my personal perspective. However, coming back to your question, getting to the unicorn status, it requires lots of capital. What's a unicorn? It's a startup that has at least $1 billion valuation. To reach this $1 billion valuation, you need traction. To get this traction, you need capital. Usually, I would say, I don't recall any statistics. I'm sure that you are able to find some on the internet, but I would say in general, to reach unicorn status, you need at least over $100 million to fundraise. So if you are a founder and you have the ambition to establish and to run a future unicorn, you have to work in the sector industry where right now the most capital flow into it. So when you look right now at the statistics where the VCs invest the most, it's anything regarding clean tech, energy providers, fintech, food tech, and lately we have the AI frenzy.
Boom, yes.
The AI boom. So if you work in the sectors, you are more likely to fundraise large amount of money, which is usually necessary. It's like an ammunition. You have to get ready for this war. So you are most likely to fundraise the necessary capital, to have enough energy, to have enough capital to reach this unicorn status, rather than work in other sectors when it's possible, but it's much more difficult. Because VCs, like even individual investors, they have preferred sectors. And either you work in hot sector where it's much easier to fundraise capital and convince investors, or maybe you work in, let's say, what are examples of sectors right now which are not such sexy? I would say anything regarding ad tech, for example, martech, ad tech. These sectors were hot among investors 5-10 years ago. It was much easier to fundraise capital.
But now...
Right now, if you work in this sector, I mean, unless you have great business traction, great metrics, it will be very difficult to fundraise.
Okay.
So you have up the hill. If you work in the hot sector, you have down the hill. Right now, if you are working on AI technology, it's much easier for you to fundraise than if you work in ad tech, which was very hard during the COVID. A lot of startups working in the ad tech sector were able to fundraise. Right now, the post-COVID era proved that a lot of these startups have problems scaling further, or selling to the strategic investors. So right now investors said, okay, maybe it will be much more difficult time for us to make money in the sector. So maybe let's stick to the sectors which are hard because, you know, it's less risky, less effort to have the same result.
Yeah, no, understood. Paweł, what other advice would you give to anybody who's possibly listening to us who is fundraising or, you know, about to start fundraising? You know, what would be your golden nuggets of advice apart from, you know, possibly change sector?
Well, no, but I mean, don't get me wrong. I do believe that if you have passion about a given problem, if you find a problem, if you develop a solution to this problem, I mean, stick to this.
Yeah, of course.
I mean, not every startup has to be a unicorn.
Yes, of course.
But you know, the most difficult part is finding the problem, the market, the product market fit. So if you find a problem which is more common, if you develop solution, stick to it. Build that experience. Maybe your first startup will not be a unicorn, but you will build an experience. You will build your brand. Because building a scaling company is not easy. Usually it's something not done at first attempt. Sometimes you need second, third, or fourth attempt, either as founder or maybe being part of the team who is working on such problem. So I would be very hesitant to advise someone, you know, to just switch and throw everything that you have accomplished and just focus on AI, for example, right now. Or
well, especially because as we see, things do change so quickly, and you know, you don't know what will be the next hot.
We also have to remember that scaling a company, if we mean, for example, building a company that will be listed on NASDAQ or building a startup that will be unicorn, of course, there are some exceptions, but in general, it takes 7 to 10 to 11 years to build such company. And meantime, there might be 2 or 3 ways of different sexy industries in the eyes of the investor. So, you know, stick what you are doing. If it works, try to improve it and make it better, unless market will prove you otherwise. But coming to your question, what will be my advice? I can share my personal experiences, not only as a fund manager, which I have been doing for the last 13 years, but also for 2 years before joining Warsaw Equity Group. Actually, I was on the other side of the market, helping startups how to prepare to fundraising and how to fundraise. I was doing that for 2 years, actually closing 1 round per month.
Wow.
So I have fairly unique experience. Supposedly I was the most active person in Poland and Central Eastern Europe.
That's amazing.
Focusing on pre-seed and seed rounds. And what made me what allowed me to have such high closing rate. With one exception, all my projects actually were able to close their round that I was helping them with. So first of all, I would say that 80% of the success is preparation. So before you go to the market, start meeting investors, you have to commit a lot of time to prepare properly. What does it mean to prepare? Not only to have your pitch deck and financial model, but also it means taking care of formalities. Do you have clean cap table, which makes you fundraisable? Do you have agreement between co-founders, if you have, regarding what happens, what's your involvement in your business, how you share your responsibilities, what happens if one of you leaves the business? Do your research regarding the market competition. In general, work on the PR, prepare all the documents that investor may ask and may require, and anticipate some questions and requests before you go to the market, first of all. Secondly, work on the traction and make sure, especially that at the beginning, that you focus not on local market, but from the day one, you think international globally.
Okay.
Actually, this is the problem, especially in the Central Eastern Europe with Poland. We are the biggest market in the Central Eastern Europe. So founders in Poland tend to focus first on the local market and say, okay, once I develop the product, once I build the first traction in Poland, then I will think about other markets. the founders in remaining Central Eastern Europe countries, especially the ones on the smallest markets like Estonia, Lithuania, Latvia, even Czech Republic, they have to think from day one about globally, or at least internationally, since let's say Estonia, the population of Estonia is the size of Warsaw.
Yes.
It's 2.1 million. In Poland, we have 38 million. So the Polish market, it's to some extent the big obstacle, because founders are not motivated enough to think internationally from the day one. So if you have not done it yet, before you fundraise, try to think, how to convince the investors, potential investors, that your product or service can compete on the global, it can be scaled and can compete actually on the international markets. The best way to prove it, actually to show that you are able to sell, to monetize also on the international markets. And probably this is what investors, especially right now, are looking for, the traction on the international markets, the growth. Right now, we are not at the stage where investors would like to see growth at all costs that we have seen 1 or 2 years ago. Investors said, okay, we don't care much how much money are you losing, but can you at least show that you are growing? Let's say 300-500% year over year. Right now, investors will say, okay, I would like to see the growth, but right now it should be reasonable growth. So, okay, show me unit economics, show me your metrics. Are they sustainable? And do you have the path to profitability? Maybe not here today, but maybe a year, 2 or 3 years from now.
Okay, so perfect. So basically, from going back to the first part of what you said, is really patience. Don't think that you're going to be a tremendous success. A year in, you need to actually have the patience to stick it out for a while. But then be fantastically well prepared and prove that you can actually scale internationally and not just be in your home market. So the top tips.
Especially that right now, as I spoke about the trends that we see on the VC market, investors are investing less capital in a smaller amount of startups. So it means, from your perspective as founder,
you need to be more competitive.
Exactly, there's much bigger competition for the smaller amount of capital. So you have to even be much better than the other startups that compete for the same capital. You have to show how you are different. How are different, on one hand, the vision, but on the other hand, the business development, the traction, the metrics. So you have to be well prepared, but also you need to have like a well-oiled business machine to win the competitor and win the minds and the hearts of the investors.
Okay, well, some great tips there. And I'm hoping that we do see a growth in the VC market in the coming years. You think there will be?
Well, let's come back to the Central Eastern Europe and Polish ecosystem to put some positive perspective. Yes, we see the downturn right now. Year to year, in Poland, it's about 50% smaller activity quarter to quarter. PFR Venture just released the report today for Q2 2023. The amount invested, it's less than 100 million euro, which is about 51% smaller than in Q2 2022. However, when we step back and have a bigger perspective, in the last 6 years, the Polish venture capital ecosystem or startup ecosystem, looking at how much capital is invested, grew about 20 times. So so this is impressive. Of course, we have the latest statistics in mind, so we see, okay, it's downturn. We're coming back to pre-COVID levels, but still it's much higher than we have seen 5 or 6 years ago. So we are still in good shape. Maybe we are not on the records, but still we're in much better place that we have been in the 5-6 years ago or 10 years ago.
So we can still be positive and optimistic.
Exactly. I mean, we are catching back to the Western Europe or the States. The COVID period actually accelerated this path. So we are closing the gap. There's the gap, but the gap is closing.
Well, on that note, Pavo, on the positive note, thank you so much for sharing these statistics, thoughts, opinions, and predictions. Very interested to see how the ecosystem in Poland and wider CEE, and of course globally, develops. And I hope we can catch up again sometime in the future and see what progression has been made.
Thank you very much.
Thank you, and thank you to our audience. Join us next time for another edition of Startup with Poland.